Welcome to CoreLogic's update on housing market conditions for June 2017. CoreLogic's May results provided further support that the pace of capital gains is losing some momentum, particularly in Sydney and Melbourne, where housing market conditions have been the hottest. According to CoreLogic's Home Value Index, capital city dwelling values slipped 1.1% lower in May, which was the largest month-on-month decline in 18 months. It's important to note, though, that May has historically been a seasonally weak month of the year. Adjusting for this seasonality suggests capital city dwelling values were flat rather than falling in May. However, there has been a noticeable easing in the trend rate of growth, as well as other indicators such as auction clearance rates, transaction volumes, housing finance, and consumer sentiment. The trend data confirms slower market conditions. The past 3 months have seen capital city dwelling values rise by a modest 0.4%, with 4 of the 8 capital cities recording a fall. Sydney dwelling values were unchanged over the rolling quarter, while in Melbourne values rose by 0.7%. The trend in growth rates across the smaller capital cities was mixed, with dwelling values across Brisbane and Adelaide continuing to inch higher, while values in Perth and Darwin showed a further easing over the most recent rolling quarter. A steep drop in the Hobart Index has reversed gains recorded over the previous quarter, and the Canberra Index was also 1.5% lower over the past 3 months. Auction clearance rates, which provide one of the timeliest indicators on the fit between buyer and seller expectations, have been moderating since mid-April, reaching 72% in Sydney over the first week of June and 73% in Melbourne. Both results were the lowest clearance rate of 2017 to date, and preliminary results show the second week of June showed some further slippage. While these figures still indicate an overwhelming majority of auctions are successful, the clearance rate is on a clear downwards trend. The number of settled sales has also trended lower, which is likely attributable to a range of factors, including tighter credit policies, affordability constraints in some markets, low advertised stock levels, and weaker sentiment. CoreLogic estimates that national settled sales numbers are 4.6% lower year on year, with more substantial falls recorded across Melbourne, Brisbane, and Sydney. On the other hand, some markets, which have been weaker, have seen transaction numbers holding firm or even rising. Year-on-year settled sales moved off a low base in Darwin, rising 2.6%, and Perth sales edged 0.3% higher. Adding to the complexity in reading the current market is the recent Australian Prudential Regulation Authority announcement at the end of March for a new round of macro-prudential measures aimed at slowing the pace of interest-only lending. Based on the new rules from APRA, Australian lenders will need to reduce lending on interest-only terms to less than 30% of new originations. Considering interest-only loans currently comprise about 36% of new mortgage lending, there's likely to be a further reduction in loans originated on interest-only repayment terms. Overall, the negative May index results from CoreLogic comes at a time of seasonal weakness, which may imply that calling a peak in the housing market is premature. But it is becoming increasingly clear that some heat has left the Sydney housing marketplace, and to a lesser extent that of Melbourne's. One of the key factors affecting housing market conditions is likely to be the fact that mortgage rates are pushing higher. Since August last year, discounted variable rates have risen by 10 basis points for owner-occupiers and by 35 basis points for investors. Mortgage rates could rise further as the recently announced macro-prudential measures from APRA progressively impact on credit policies, as well as the federal government banking levy comes into effect on July 1st. Small rises in mortgage rates are likely to have some impact on housing demand, considering household debt is tracking at record highs. For investors, the higher cost of servicing their debt comes at a time when rental yields are close to record lows in Sydney and Melbourne, which are also the 2 cities with the largest concentration of investors. Landlords are likely to be trying to push their rents higher, but this may be difficult considering the weak wages growth environment and higher level of rental supply in some regions. If investors are concerned about the run of capital growth in the 2 largest cities coming to an end, more astute investors may start to change their focus towards the rental return, given the possibility of lower capital growth potential. Yields are much healthier in cities like Hobart, Brisbane, and Canberra, and the growth cycle is nowhere near as mature as what it is in Sydney and Melbourne. In summary, the jury's still out on whether the housing market has peaked. However, if it hasn't, a peak could be just around the corner. The housing market remains as diverse as ever, and the flow of data over the coming months will be a critical factor to get a better understanding of the trends. Of course, you can stay in tune with regular housing market updates via the CoreLogic website at www.corelogic.com.au.